Ladies and gentlemen, how do you do? I'm your host, Seth Julian. Welcome you to today's session. We are looking at the U.S. interest rate underimposed by the S&P 500. Now, the reason we focus on this is because Chairman of the Federal Reserve Bank, the United States Central Bank, Jerome Powell, yesterday and continuing into today, is making his semi-annual testimony to the United States Congress based on his assessment of monetary policy. Our assessment of monetary policy. As interest rates are low, meaning money is cheap, the stock market goes up. When money becomes more expensive, the stock market doesn't like that and reacts negatively. When money is cheap, the stocks boom. When money rises, it's almost right down to the same line. This is the beginning of 2022 here. It's marked December 2021 as the Fed gets hip to the persistence and prevalence of inflation rather. It decides to act and raise interest rates, at which point the stock markets promptly turn down. So that's your relationship between rising interest rates, well, I should say inflation and rising interest rates. And again, just as a matter of review, why do we need to slow the economy down to the point of layoffs and recession in order to squeeze inflation out? Because of greed, ladies and gentlemen. Prices will naturally rise whenever possible. People, corporations, firms, professionals, amateurs, crooks and thieves will all raise their prices whenever they can, but won't when competition prohibits that. Once the genie is out of the bottle and price rises are accepted and part of the economic landscape, prices will rise. They're very persistent. It's a very pernicious phenomena to arrest. And the only way we have to arrest it is the blunt and crude instrument of inflation, raised interest rates, which causes a recession. It causes the economy to slow down such that you can't raise your prices, because if you do, your competition will take advantage of that move, and therefore you are limited. So this is the relationship between the rise in interest rates, this blue line, and the prices on the S&P 500. I want to show you another relationship that we believe is crucial. This is the U.S. dollar index. This is a index of the strength of the U.S. dollar weighted against 6 other currencies. So you can see, as Powell says, as he said yesterday, is likely to reinforce again today, interest rates are going to stay higher than expected by the market for longer than expected by the market. And again, this is because if we go back to this chart, I want you to look at where the long-term interest rate is. It's somewhere, this is the wrong scale, excuse me. Let me make this the regular scale. It's the regular scale on the interest rate. Oh, I'm sorry, my mistake. That was the regular. This is the long-term interest rate is somewhere around here. It's 5.5%. You can see it by just eyeballing the graph. And so therefore, we're not even there yet. We're at 4.75. We've got a ways to go, and we're going to be there for a while. That, ladies and gentlemen, has a direct effect on this, the strength of the U.S. dollar. This is the graph of the U.S. dollar index. As it rises, the U.S. dollar becomes more powerful. It buys more of other currencies and requires less U.S. dollars to buy more of those currencies. So that's another effect. As this goes up, stock markets generally fall. However, when you start to look at the strong dollar, you see the effects as well. Oh, just let me show you on the real S&P chart, if you don't believe that superimposed job. Here's the S&P let me move this, is the S&P 500 on a 4-hour. It fell. Here's Mr. Powell's testimony, and boom, it falls into the toilet. So those are the relationships that exist between inflation, interest rates, and stock market evaluations. We expect the effects of Powell's testimony to be long-lasting, and we furthermore expect the decline in stock market valuations to continue for some time as inflation, the battle of inflation, continues to unwind. And on a final note, ladies and gentlemen, let me say that these are speculative observations, meaning we could be wrong. meaning that there's risk in these markets, and risk, of course, is defined very simply and precisely as the probability of the unexpected occurring, and it occurred. Beware. And so you must be only trading with money in these markets that you can afford to lose. As speculators, we have to be keenly aware of the risks we face and do the best we can to counter them. So, ladies and gentlemen, that's going to do it for today. I'm your host, Seth Julian, wishing you all, ladies and gentlemen, the ability to trade with confidence. Chalas for now.